Hey guys, in today's video, I want to talk about some key lessons that I learned on growth stock investing from this big book, Security Analysis. If you want to check it out, I've got a link in the description down below, but I figured it would be a great time to share some knowledge on growth stock investing as growth stocks have come back down to earth, dropping 30 to 50%. So I wanted to give you guys some tips and tricks on what to look for in a great growth business going forwards as you're planning out your next play. If you're interested, you can check out my Patreon group where I'll be posting all my buys and sells, but there's no pressure to do so. I'll continue to post free content on here for you guys. So let's get right into the core of this video. Starting off, people like to invest in growth stocks because the value stocks are generally more boring. Maybe you see a 5 to 10% increase in a year. However, in the past couple of years, we saw that growth stocks have done extremely well. Some of these 2x, 3x, 5x, or even 10x. And there's nothing wrong with investing in growth stocks. However, there are higher risks compared to these companies that are more value oriented and have a proven out business. And the reason why growth stocks tend to do well sometimes is because people like to speculate on the future. For example, if you were to go back to the year 2000 when the dot-com bubble was happening, everyone was buying into every single stock that had anything to do with the internet. And some of these stocks out of the dot-com bubble did very well over the next 20 years. However, there are many of these stocks that have also failed, and people don't really talk about these. Companies like pets.com absolutely just went to zero. However, the most famous story from the dot-com bubble is Amazon. If you bought Amazon back in the year 2000, it was trading anywhere between like $40 to $100 per share. And when the stock crashed, it dropped to maybe back to about $40 per share or a little bit lower than that. But if you bought at the peak of the dot-com bubble of Amazon and you were to have held it till today, you would have still seen about a 3,200% gain, even if you bought at the height of the dot-com bubble. So right now, people are still speculating on growth stocks to this day, hoping to find the next Amazon out there. And there's nothing wrong with that, but as long as we learn how to control our risk. Because according to this book, Security Analysis, that I've been reading, one nugget of information here is that we must look for businesses that will generate significant amounts of cash flow in the future. And there are 6 characteristics of these businesses. The first one is strong barrier to entry. So you don't want a company that's easy to replicate. For example, if I were to start a lemonade stand, there's nothing really unique about that business. But if we compare a lemonade stand business to Apple, for example, they've built a business on an extremely strong brand. And that's one of the biggest things that Apple has. Their brand, their software, their hardware, the unique look, these things all make Apple unique. Making computers or cell phones is not novel, but the brand power behind Apple is what's novel, and that's a strong barrier of entry for any new entrants. Another reason why Apple might have a strong barrier to entry is because it takes years and years of development for people to catch up to the sophistication of Apple products. So this is another major barrier to entry for anyone looking to enter the PC market or cell phone market. They have to be able to build up just as strong of an ecosystem or software platform for people to switch over to, and that is not going to be cheap. So this is a moat that Apple has for any potential competitors. Limited capital requirement is also another key characteristic of a good business. And this allows businesses when they start out small to prove that they do actually have a business and get some more investor dollars to scale. However, if you're demanding billions of dollars of capital requirement just to get your business up and running, there's a huge risk there. So you want businesses that can be able to operate on a lean manner or know how to function with limited capital and still build a business where they pump out products that people want. Reliable customers is the third characteristic of a good business because you want a business that has customers that are coming back to you again and again to buy your products. That could be a customer that comes every 3 years reliably or every week. That's why people love SaaS businesses right now because the customers are extremely reliable. They sign on to 1-year contracts or multi-year contracts where they're locked in for a fixed monthly fee. And the revenues for these companies are very predictable because they've locked customers into these contracts. Low risk of technological obsolescence is another key factor for business. You don't want to have a business where you're building technology that's starting to become outdated. For example, no one's developing new films for film cameras because that technology is pretty much dead. It's nostalgia when people are using those cameras, but you're not going to build a multi-billion-dollar business in today's world if you're trying to develop the next best film camera. Everyone uses digital cameras or their cell phones nowadays. Abundant growth possibilities is a fifth characteristic, and this is just kind of a given. You want a business that has many different growth vectors where they can scale their business into, not just to be pigeonholed into this one single aspect or one single business. Like if Apple's just stayed into computers, then the business would be very limited and likely they wouldn't have succeeded like they are today. However, Apple is more of a technology company, and building a PC was the first step in their technology innovations. However, they continue to innovate across different personal computers or computing devices, and that's how they branched out, and now they're even getting into software and other aspects of technology in this world today. And if a business has all these characteristics and manages to execute flawlessly and build a product that people want, then they're going to generate significant cash flows and reward investors in the end. So right now, as growth investors, we're searching for those companies that have not yet proven out their business where they're able to generate significant cash flows, but we're looking for these other 5 characteristics of their business and their core product today, and kind of dreaming of where they can go in the future in order to generate these massive cash flows like these giant internet tech companies that we know today, Amazon, Apple, or Google. Further down the page, the author of this section, Seth Klarman, states that today's good businesses may not be tomorrow's. And this rings true even if we go back 20 years ago. Businesses 20 years ago who were at the top of the S&P 500 or the Dow Jones, a lot of them are not there anymore. They've been displaced by these large internet companies, which are the businesses of today. Now, if we look 20 years down the road from today, maybe Amazon or Apple, they might not actually be the biggest company out there 20 years from now. I don't know, it's hard to tell, but that's why as growth investors, you kind of have to extrapolate what you think the future could be and invest in those companies. But most of the time, just take note, like the dot-com bubble, a lot of these companies can fail. But if we hit jackpot with 1 or 2, we could see 100x on our initial investment that might make up for our failed investments here. Now, this is kind of the way that venture capitalists think when they invest into startups, and it's even more riskier there. So when you're looking into growth investing, seeing if this is the right path for you, just know that there are a lot of risks and you may see a lot of red in your portfolio as these growth companies are not proven yet and some of them will fail along the way. And the market also does have swings of ups and downs for growth stocks, and these growth stocks tend to have a lot more volatility. So sometimes, just like in the past couple of months, these growth stocks could be trading at extremely high valuations where the premium you're paying for them has a lot of the future growth priced in already. However, valuations have come down quite a bit from a couple months ago. Maybe there's a bit more to go. It's really hard to say for certain, but sometimes throughout history, the author writes, failed growth stocks are often so aggressively dumped by disappointed holders that the price falls to levels at which value investors who stubbornly pay little or nothing for growth characteristics become major holders. So right now we may see a huge sell-off in growth stocks and there may be more to go, but at some point in time, potentially some of these growth stocks could be even trading under book value, where value investors may even look into these stocks and become major holders because growth stock investors have dumped them and become disappointed with the returns on the investments. So maybe in the near future, these growth stocks could continue to see dumping by the disappointed investors, but we should always keep an eye out for value in these growth stocks, such that if these growth stocks trade like at a P ratio of 10 or 12, at that point, I would say these stocks have basically hit rock bottom and it's time to buy in and become a major holder because there's a lot of value in the growth and it's not priced in. But right now, I'd still say growth stocks still have a good amount of the future priced in, but slowly the valuations are coming down. Now, when we look back 2020, we can see that earlier this year, growth stocks were highly priced and a lot of the future was priced in. And the author states here, investors should be especially vigilant against focusing on growth to the exclusion of all else, including the risk of overpaying. So I would agree with him here that I probably overpaid for some of my growth stocks in the past couple of months just because the market was frothy. So I think this is a lesson learned going forwards that stocks don't just continue to go up, valuations have to make sense, and even if the stock continues to go up, it's likely just momentum traders pushing up the price. And we can't give in to the FOMO that we feel when we look at this stock that we're like, man, why didn't I buy that 5 days ago when it was down by like 60% compared to today's price? I could have made 60% in 5 days. We can't just look at that because eventually the market will correct itself whether you like it or not. And I can feel the pain that a lot of growth investors are going through right now, where we thought a PS ratio of 20 was a decent value because another stock was trading for a PS ratio of 40. But when you actually look at the business and the underlying fundamentals and how much cash flow they can generate in the future to give you a good return on your investment, a PS ratio of 20 is probably a lot higher than you should be paying for the business right now, as it hasn't even proven out that it has positive cash flows or maybe just started to break even. So keep in mind these things going forwards when the next bull run comes and all these growth stocks are flying up. If you're a momentum trader, you can ignore everything that I said. However, if you're a long-term growth investor looking for value in growth stocks, then keep in mind what I said in this video next time you feel FOMO, looking at a stock that just popped 20% on earnings. Anyways, that's all I have for you guys today. Just wanted to share this nugget of wisdom from this super long book that I'm reading right now. I'm just through maybe the first 30 pages. If you guys want to read this book for yourself, you can check out the link down below. It's about $60 on Amazon, and it was discounted by about 50% when I checked on there. Anyways, that's all I have for you guys today. If you guys want to check out a couple other videos, I'll throw them up on the screen. If you're there, I'll see you there. If not, keep up the grind and have a great day.